Good morning, everybody, and welcome to our next monthly IFRS webinar. And this month, we're looking at the basics of tax accounting. But first of all, good morning, Kevin.
Good morning, Aletta. It's good to see you again. And finally, I think we're both in lockdown at the same time. So finally on equal footing. Nice to see you down in Melbourne again.
My question is, did you have an earthquake this morning, Kevin? Because we had an earthquake. It was rattling and shaking all around me. The kids were running outside. So are we really equal? That's the question.
No, but you did choose to go live in Melbourne, and I cannot understand why you chose to go south. I mean, Sydney's still the greatest city, but let's go with it and move forward. Hello, everybody on the webinar. Nice to see you all again today.
It's always good to have some different opinions. I love the sports capital of Australia. All right, uh, and off we go. The basics of tax accounting. Um, so first of all, I should say that this is the first of a two-part session on income tax, AASB 112 or IAS 12. So this month we're looking at the basics of tax accounting, really the basic principles. And then next month we're looking at some more complex issues. Now, Kevin and I thought we'll look at deferred tax implications of leases, which has been a hot topic. It's been included in some of our newsletter articles over the last 2 months. We look at deferred tax implications of business combinations, a topic dear to our heart, and we see a lot of it in the market at the moment. Deferred tax implications around goodwill or not, intangible assets. So more the difficult stuff, definitely next month. So this month is an introduction. So our Sydney is King proponent or a proposer, Kevin, is on the call as one of the presenters. And then Melbourne is King Aletta is here. Our upcoming webinars for the rest of the year. So next month we've got more complex tax accounting. In November, a very important one. Please register as soon as possible. Our accounting standards update, getting ready for 31 December 2021 reporting season. I know most of you are still struggling to finish 30 June reports, but if you've got a 31 December year end, or starting to think of half year already, that November webinar is a must watch one. And then in December, we want to look at foreign exchange complexities. So it won't be basic principles, but some of the complex questions and issues we are seeing. Potentially around, foreign operations, accounting for those exchange differences. So if we go back to this webinar, when we get to the part on income tax, 4 key parts, we'll do a bit of background. We'll look at basic principles. We'll briefly look at the calculation of current tax, and then we'll look at the calculation of deferred tax. And in particular, our focus will be on how do you determine the tax base of an asset and a liability. And Kevin, this is the one thing we do agree with, that on the tax base of an asset and a liability, there's 2 rules and only 2 rules on how to determine the tax base of an asset, and only two rules on how to determine the tax base of a liability. In total, 4 rules, that's it. If you know that, you can do deferred tax. And I think that's critically important. I should say the other thing, even in BDO and often when we speak to clients, there's this debate on who's responsible for deferred tax calculations. Is it the tax people, or is it the tax partners and the tax team, or is it the IFRS people and the accounting people? And I think it's an interesting overlap between the 2 disciplines, because a lot of this is around what is the carrying amount for accounting purposes. And then there is what is the tax base of these assets and liabilities as defined in an accounting standard. But in order to work out that tax base, as defined in the accounting standard, you have to understand the tax legislation applicable to that item. And I think that is the interesting place. So I can see tax people getting involved in giving input on the tax base, and that's it, right? Because the rest are all accounting. But an interesting discussion. And I always say to the tax people, I'm interested in the definition in IAS 12 and how that applies. However, before we go on to income tax, I thought I'll use this opportunity to talk about ESG and sustainability reporting. Now, this is I said yesterday to one of my fellow partners, I think this is the fastest moving topic I've ever seen in 30 years of accounting. And what I mean by that, in December, I received a phone call from a client talking about, what can you help us around ESG sustainability reporting? And that was the first client really reaching out to us in BDO Australia. And can I tell you, 10 months later, it feels as if I'm taking phone calls on a daily basis on the same topic. So it's amazing how this has gone from zero to very high on the charts within a short period of time. Unreal. Usually with accounting standards, there's a discussion paper, there's an exposure draft, then there's a standard, then there's a period before implementation. This is just going much faster than that. Um, and therefore, I want to talk about this today because I think there's a big responsibility on us to say this is very relevant to all our webinar attendees. This is very relevant to all businesses. And this is the problem as we see it. And speaking to clients, speaking to stakeholders, this is what we're seeing. And first of all, stakeholders are demanding greater transparency from organizations about long-term sustainability and their ESG impact, and how do they create value for all stakeholders in future. So questions that's been asked of entities are, what is your social license to operate? What does your ESG performance look like? How does it compare to others? How does it compare to your peers? Now, let's make it a bit specific. If you're a for-profit entity, we know clients are telling us their investors are asking them, what are you doing around ESG? How does a sustainable future look like? And investors are directing funds preferentially and sometimes exclusively to sustainable entities. So there's a big pressure coming from investors, and if it's not there yet, it is coming. And then financiers are facing increasing pressure to only finance sustainable entities. And the other thing that I'm hearing on a regular basis is that loans that are now provided to clients are linked to the entity's ESG performance. And therefore, something like if you meet certain ESG targets or achieve a certain ESG rating, maybe the interest rate on your loan is 3.25%. However, if you don't meet those ESG targets or ratings, the interest rate will be 4%. So interest rates are linked to ESG performance, so we get these green bonds, and financiers are increasingly looking at this. Now, the third bullet point there is the one that I really want to highlight. And that is when I speak to smaller entities, small and medium-sized entities, family-owned businesses, they would say to me, Aletta, why do we have to do this? Who is looking for it? Who is interested? Now, if you are arguing you don't have external investors or financiers interested in it, I want to tell you something. Supply chain will get to you very fast. Because if you are supplying goods or services to larger organizations or government organizations, who are, or other SME organizations who are subject to ESG performance and sustainability performance, they will look at their whole supply chain, and they would say it's not just what is our ESG rating, but also what is the ESG performance of those providing goods and services to us. So if we are importing goods from overseas, the ESG aspect about not using child labor would be applicable as well. So supply chain will get to you very quickly. Then for not-for-profit entities, and this one is very near to my heart. I'm a board member at a not-for-profit organization, Hagar International Foundation, and I know for us, um, if we want to attract funding from government, from philanthropists, from all the various funders, we have to demonstrate our impact. And usually the impact for a not-for-profit is around social impact, but it's the S of the ESG. But we have to demonstrate that. We have to prepare an impact report. And government favors entities that can demonstrate a positive impact. Maybe they're interested in the S, the social impact, but it's still part of a bigger ESG impact. So this is the business problem, and it cannot be avoided. And this is coming very fast. It's unreal at the speed of what this is moving. And therefore, I want to put it on your agenda. I would imagine that in upcoming AGMs, for examples, there could be questions around ESG performance and how do you respond. And I think that's where we could help you. So please reach out on that. Now, when we talk about ESG and sustainability, a lot of people say, what do you mean? What is ESG? Is ESG just environmental aspects? Now, I've put this diagram together and it was included in an accounting newsletter, I think 2 months ago. Where I did some research and looked at all the frameworks out there, and I'll give you some slides of some of the frameworks I've considered, but I've pulled together, under the E, the environmental factors, S, the social factors, G, the governance factors. For each of them, I've put together 8 quite common subcategories that I've seen in the literature, and I'm currently working with clients to look at these factors, to what extent they're relevant, and therefore that they want to measure and report. So maybe I should say up front, not all 24 factors on this slide would be applicable to each and every organization. Not every organization's stakeholders will be interested in all of these. However, you should, as a starting point, consider which of these factors are relevant to you and your stakeholders. So let's start with a quick comprehensive overview. So environmental factors around climate change, land use and ecological sensitivity, air and water pollution, biodiversity, deforestation, energy efficiency, water management, fresh water availability. If you're in the mining space, if you operate anything that has an impact on the environment around you, stakeholders would be interested in it. How do you minimize the impact? How do you invest money to repair the environment around you, etc.? But those are the different categories, and we can go into each one of them and look at them separately. If you look at social factors, now this is so important. For not-for-profits, this is absolutely it. Customer satisfaction. Do you measure, report customer satisfaction? Do you do customer surveys? Next one, data protection and privacy. We all know cybersecurity, or what you do with the data you capture of customers, suppliers, etc. Very important. There's rules around that. Even our accounting news, you subscribe to the accounting news. We just don't bombard you with newsletters. That's part of what we're allowed to do with your email address. If we look at diversity and inclusion, so not just gender diversity, but diversity and inclusion across a wide range of areas. So do you measure it? Do you report it? Is it important for your stakeholders? So how do we make a diverse group of people a part of your organization? Um, and not just at the lower level, right through to a governance level. Employee engagement. Do you do surveys of employees? To what extent is it a safe workplace and a good work environment for employees? What about health and safety, including mental health, especially now with COVID-19? What are we doing to look after the health and safety of our people and mental health? Community engagement. You know, do we have a positive impact on the community around us? Do we interact with the community where we're based? Do we have the necessary, the required respect for Indigenous owners of the land? And how do we involve them in what we do? Human rights, which includes modern slavery. Um, Wealth creation and employment, again, it's an impact on community. So social factors, these things are important to stakeholders, to your employees, to your suppliers, to your investors. Um, Governance factors. Now, governance factors, I would say, tone at the top is all it's about. It's the start of everything. So do you have a governance framework? What is your governing purpose? What is the quality of your governing body? A number of things to look at. Stakeholder engagement. What about ethical behavior, anti-money laundering, risk and opportunity oversight, bribery and corruption, executive compensation, lobbying? So which of these factors are important to your organizations and the stakeholders of your organization? That's the starting point. And do we measure and report this? Um, and this will be a journey, by the way. We won't have all of this in place today. Now, a lot of people, there's a lot of frameworks out there. A lot of people have issued frameworks. At the moment, um, with accounting standards, we've got mandatory general purpose financial statements from 30 June next year in compliance with Australian accounting standards and IFRS. Sustainability reporting, a lot of frameworks, nothing mandated, no mandated framework, a lot to happen. And the standard setters are trying to catch up quickly, so we wait and see what they do. The United Nations have issued 17 Sustainable Development Goals, and you'll see all of these are covered in the previous slide that I've put together, but some organizations focus on these Sustainable Development Goals. That's their framework of choice. Others look at the 4 pillars of the World Economic Forum, where all of these factors are grouped within principles of governance, planet, people, prosperity. So all the factors I've discussed at length fit into one of these. So there's different frameworks. There's the Global Reporting Initiative. There's the Value Reporting Foundation that has issued standards. So really important that there's a lot of frameworks. So I think what's important, Kevin and I know, have always argued that ultimately financial statements is about communication to stakeholders. And in the past and to date, financial statements were prepared and used to communicate with stakeholders. And these financial statements were often mandated and they have to be in compliance with certain accounting standards. On the right-hand side of the diagram, I've said a sustainability or an ESG report. I use the two terms interchangeably. It's sustainability, it's ESG, same thing. Should be prepared, I believe, in accordance with what, not sure. So at the moment, if you prepare it, you are in charge of your destiny. But I think with these red arrows, I'm trying to illustrate there's an interrelationship between financial statements and the sustainability report, and together it's the future of communication to stakeholders. So what are the standard setters doing? At the moment, on the left-hand side, we've got the International Accounting Standards Board that issue international financial reporting standards, and it's under the oversight of the IFRS Foundation. Now, the IFRS Foundation, I suppose, has a similar view to us and is saying we believe we need a one-stop shop, sustainability standards board. They would like to establish that board to bring all the frameworks together under the IFRS Foundation. And the reason is to make sure that the International Accounting Standards Board and the Sustainability Standards Board work together and there's interaction between the two. Because I think future of communication is the two together. And it looks like the standard setters have the same in mind. So in my view, and this is just enough, the accounting newsletter that's going out tomorrow or maybe early next week for some officers, I've put in an article on the first steps toward a sustainability report. And I believe the absolute first step is a materiality assessment. So an organization has to go through a process on who are your stakeholders. And it's not just the stakeholders as outlined in the new conceptual framework. This is customers, customers, suppliers, government, etc. Who are your stakeholders? And then what do your stakeholders want to see in your communications? So if you look at all those 24 factors, we should engage with these stakeholders and say, which of these 24 factors would you like to see information on? What is important to you? It could be a survey, it could be workshops, it could be interviews. And we're in a process of doing this for some of our clients to look at stakeholders and look at what they are interested in. Because not everybody has an impact on the environment, for example. And the next thing is we need a governance framework, and we should review our governance framework down at the top. Third thing, we need to do a maturity assessment. So if we know what areas or which factors your stakeholders are interested in, we should have a maturity assessment. What is your current position on those factors? And it might not be a beautiful position, but what is the current position? And then also, so where do you want to go on those aspects? And then we have to come up with a roadmap. So people are not looking for perfection today. But I believe at your AGM, if we can at least articulate that we know who our stakeholders are, we know what factors they're interested in, we've done a maturity assessment, we know what our position is, we know where we want to go, and we have a roadmap. I think that's the best answer at the moment, unless you've done it all and you have a fantastic position to present. But I think to be proactive, that we've got a roadmap, we've done all this work is critical. So I would like to say, if this is what you're interested in, please reach out to us because we would love to work with you. We're currently working with clients, and this is really important at the moment. So I think going forward, to me, the absolute way forward is an integrated and a holistic approach. It's a holistic and integrated reporting to stakeholders around the mandatory general purpose financials and voluntary sustainability report. And whilst it's voluntary and while we don't have mandated disclosures, let's shape what the best disclosures for each organization is. Let's use the opportunity because that will then inform standard setters in their research. So we have to be ahead of the curve here. So that is just my introduction. I think this is a really important topic. I will go back to the topic of the day, and that is background to income tax. Now, if we look at background to income tax, maybe I should just pause there. I'm sorry, Kevin. I'm just going to go back. Was there anything you wanted to add on that? I just rushed past it, and I didn't even give you an
No,
opportunity.
I think that's absolutely great, Aletta. Just to reiterate the concept that we're getting a lot of this and we're seeing a lot of these queries arise. And let's face it, COVID I think is resetting the international community and the local community. And just that we felt it was important to put this on the agenda now already because it's actually moving quite fast. And believe it or not, with the slide that's on the screen right now, even today's topic interacts with this, believe it or not, because I guess as a social responsible organization paying your tax, believe me, that has an impact on your sustainability and your social license to operate. So there absolutely is a connection there as well.
Fantastic. Thank you very much, Kevin. So I'll do a bit of an introduction and then Kevin will take over. So if we look at the background to income tax, I think the key question is always deferred tax, and everybody says it's difficult. And when we speak to clients, there's always this, oh, deferred tax. So why is it so problematic? And it's problematic because accounting profit is generally not the same as taxable profit. Um, and the reason is accounting profit is determined by using all these books, all the accounting standards, a whole set of legislation. And then if you look at the taxable profit, it's a different set of legislation. And luckily, I don't have all that legislation with me. That would be too much. My head will explode. So there's a lot of literature around accounting profit and a lot of literature around tax rules. And therefore, accounting for that difference between the two is quite complicated. And that's often why we need tax experts to look at the tax rules and how that impacts the tax base. And we need the accounting experts on the debits and the credits and the carrying amount and the disclosures. So this is somewhere where we have to collaborate. So applicable standards, I've just made a list of some of the applicable standards. In Australia, we have an interpretation 1003, Australian Petroleum Resource Rent Tax, which is one of my, whenever I see it, I get quite nostalgic because when I worked at the AASB, that interpretation was my baby. And I remember the day I was so excited when it finally got approved. But anyway, so those are the accounting standards. If you look at the basic principles, the basic principles is if you look at your statement of profit and loss and other comprehensive income for a particular year, in that P&L, other comprehensive income, we work out our profit before tax, and then we've got that one line income tax expense that would usually reduce our profit to get to a profit for the year. Now, a lot of people expect that income tax expense to just be 30% of profit before tax if the organization pays tax at 30%, which I know is not always the case. And so there's an expectation that income tax expense is 300. Now, we know that's not always the case, but we have a reconciliation that we disclose in order to show people why the income tax expense is not 300 as expected, but is something else. And that's the purpose of that reconciliation, to reconcile back to kind of a general expectation. So accounting profit is defined in AASB 112 paragraph 5 as a profit or loss for a period before you deduct that tax expense, the yellow that I've shown on the previous slide. And taxable profit is your tax or your loss for a period determined in accordance with the rules established by the tax authorities, Income Tax Assessment Act in Australia. What's important also is we often get the question on when should we account for the tax effects of a transaction? Because we could have a lot of transactions that have before reporting date, and some of it could already have tax implications and therefore it would be current tax. Or those transactions that's already happened could have tax implications sometime in future, and that's called deferred tax. So the question is, why do we account for these tax that will come into play in future? Is that not wrong? And the answer is we are looking at transactions that's already occurred. We've looked at balances at reporting date that's already in place. And we are looking at the tax consequences that's already materialized, would be current tax, and the tax consequences that we expect in future, relating to transactions that's already happened should also be reflected. So don't get confused about this. We're not accounting for future transactions. We are accounting for transactions that happened before reporting date. And we are accounting for existing and future tax consequences of those, which is very different. And that's an important principle, and we often get asked that question. So if you look at steps to apply these core principles, you have to do two tax calculations at reporting date, double the fun. The first one is you have to calculate your current tax liability. So that is the current consequences of transactions that's already happened. And that's the amount you have to pay to the ATO. But you also have to determine the net effect of deferred taxes and deductions, important, from transactions that occurred during the year, although they have future tax implications. And we use the balance sheet approach. So two types of calculations that we have to do at reporting date. So if we look at the calculation of current tax, now this is what the tax people would do, but important to know that, when we speak to our tax team at BDO, they have to know how we've calculated profit before tax. The reason they have to know that is they start their tax calculation with profit before tax. So if there are things in accounting profit before tax, right, that shouldn't be there for tax purposes, they should take it out. If they don't know what we've put into that calculation, how would they know what to take out? Right? And that's why they need training around accounting as well. So we look at all the revenues and expenses, and we consider whether all the revenues are indeed taxable, whether all the expenses are indeed deductible. Maybe there are additional items that should be taxed. Maybe there are additional items where we can get deductions. And we often look back to prior year worksheets to identify reversals of prior year differences, maybe assessed losses that are carried forward. So a very simplistic calculation that the tax guys would use is they start with accounting profit before income tax. So I'm saying again, they have to know what's in there. And then they add back non-deductible expenses. They deduct non-assessable revenue. They deduct any deductible amounts that's not included in our accounting P&L. They add back assessable amounts not included in the P&L. They consider assessed losses from the previous year, and that would give them taxable income. So that's a simplistic approach. Important, tax don't start all over and capture all the transactions in a tax balance sheet. They start with our accounting profit. And it's really critical that they understand how we calculate our accounting profit. So how do we calculate that current tax? Once you've worked out taxable income, you'll multiply it with 30%, and that will give you your current tax payable. And if it's a payable, it's debit income tax expense, credit current tax payable, ATO payable, some kind of liability. And then what about assessed losses? What are the journal entries around assessed losses? If we had an assessed loss at the end of the previous year, and we now use that as, we would now use that assessed loss in our current year. What do we do with that? What would the journals be? So we should first determine whether we recognized a deferred tax asset at the end of the previous year or not. So the fact that you had an assessed loss at the end of the previous year doesn't automatically mean that you've recognized a deferred tax asset at the end of last year, because there's certain rules. You'll only recognize deferred tax assets if it's expected to reverse in future, etc. There's rules, there's guidance. So don't assume I've had an assessed loss, I've booked a DTA. So in my example, I said, let's assume that we had an assessed loss of $1,000, And let's assume we recognized a DTA in relation to 600 of it. So we recognized a DTA of 180. We had an unrecognized DTA of 400. So we didn't expect profits, taxable profits in future, against which this would reverse. So we didn't recognize a DTA for 400 of that 1,000. And now in the current year, miraculously, our current taxable income is 5,000. So what would we do now? All right, so the fact pattern, very simple. In this situation, we would say, hang on, first of all, I would recognize that DTA in the current year that I haven't previously recognized, that unrecognized part, the 120. So when you recognize a DTA, the credit go to an income tax expense. So let's deal with that first of all. Now all the assessed losses are at least captured in a DTA. And then I would work out what is my current tax liability. And that would be the 5,000 less the 1,000 assessed loss. So on 4,000, I have to pay tax at 30%. So I'll have a current tax liability. And I would say, hang on, this DTA that I have in place, I now have to utilize. So credit that DTA with the 300, and my debit is my income tax expense balancing figure is 1,500. So I've done 2 journal entries to address for this in the current year. So it's quite a complex example, although it looks very simple, but I challenge you to just go and look at that to make sure that if you've got an assessed loss, you consider, did we book a DTA or not? First step, book the whole DTA in the current year and then utilize it at least. So what are the journal entries around assessed losses? Your general principle for deferred tax liabilities would be you would always recognize a deferred tax liability for all taxable temporary differences. Around deferred tax assets, we're more careful. You'll only recognize it to the extent that it's probable that taxable profit will be available in future against which we'll be able to use it. So your recognized DTA is a probable future taxable profit, and unrecognized, it's not probable, but we still disclose it in the notes. Because in my example, if you make a profit the next year, it's always there to utilize whether you've recognized a DTA or not. Now, Kevin, I am absolutely exhausted. And I can see you are eager to get involved. So I'm going to throw over to you to look at the calculation of the deferred tax.
Thank you, Aletta, and sterling job up to this point. 38 minutes without a water break. Go for it. Have a sip of water, Aletta. Um, Thank you for that. And it is an interesting topic. I mean, I was listening to Aletta speak, and as much as we deal with this all the time, in our team, it is refreshing to hear some of the issues that we run into again from another perspective, because a lot of what happens in the current tax and deferred tax accounting does, as Aletta say, interact a lot with the tax specialists or the people who do your tax, and you do have to kind of bridge that divide. And the calculation of deferred tax is by itself probably the most interactive, regular place in accounting where different specialisms are coming together. And I'm glad you spoke earlier about that, Aletta, about who does the calculation for the deferred tax and how do the two interact, because deferred tax is coming together of your tax transactions, shall we call it, and your accounting transactions. But the biggest misconception in accounting for deferred tax is, as Aletta said, it's not really transaction based. The calculation of deferred tax is actually about temporary differences on the balance sheet approach. The problem is no one knows what that means. And especially if you're from the generation that I came from in the good old days, and Aletta, you're probably in this camp as well, we first learned how to do timing differences. But we don't do timing differences anymore because a timing difference in deferred tax is the difference between the accounting profit transaction and the tax profit or taxable income transaction. But deferred tax on the balance sheet approach is actually about the tax consequences of the realization of assets and liabilities. And Aletta used that word a few times. I think she also called it tax implications, the future tax implications. But I actually prefer tax consequences, which Aletta you also used at some point. The tax consequences in the future on the realization of assets and liabilities. So I'm going to take you through that. And Aletta, if you don't mind moving the slide a little bit along, because Aletta's got control of the slides today. What we've put up on the first one is how do we calculate deferred tax? And you'll see very quickly that what we're actually doing is a balance sheet approach, which means you're actually comparing the carrying amount of the assets and the liabilities against their tax base to work out the taxable temporary differences and the deductible temporary differences on the balance sheet. Now, I'm going to put it a different way, and you'll see in our examples how we do this. The idea of deferred tax is the tax consequences that flow not from the tax transactions, but from the realization of the carrying amount of the asset and the liability. Now, I'll give you an example. We're going to have a couple of examples coming forward. Maybe we'll deal with it that way. But if we have an item of property, plant, and equipment, and this happens to be one of our future examples, and let's assume it's got a carrying amount of 100, what that asset actually represents, that $100 of property, plant, and equipment, that's actually future economic benefits. Call it taxable income through revenue if you want to, but ultimately the idea of that asset on your balance sheet is it will give rise to an economic benefit in the future. Either it's going to be a revenue because the asset will be used to generate revenue, or it might be the sort of thing like a receivable where you just get paid the cash from the debtor. It comes in by way of cash. But if you think about it, what are the tax consequences when that asset is realized? What's going to happen in your tax calculation and your taxable return? And that's what we're trying to capture in deferred tax. It's the tax consequences of the realization of the asset is what actually is deferred tax, and the obligation when you pay the liability, being the carrying amount, the tax consequences that flow from those realizations and those obligations is what we're trying to capture in deferred tax. Now, the trick with the rest of today's session is that there's really only 4 rules. And the reason why we're only spending time on the 4 rules is because if you don't get the first 4 rules, you're never going to get the complex stuff next week. So that's why we're spending time on the 4 rules. Now, Aletta and I spoke at length about this. If you can get these 4 rules down pat, you're going to be okay. The reason why there are 4 rules, I call them rules 1 to 4, but Aletta calls them 2 rules for assets and 2 rules for liabilities, but it doesn't matter, there's 4 rules. The reason why there are 4 rules is the rules to calculate the tax base. It actually tells you how to work that number out for each of the assets and liabilities. I don't use the tax rules because I think of when I do deferred tax, what I actually do is I do tax consequences. When this asset realizes what's going to happen in my tax return in the future, that's how I do it. The tax rules in the standard are there for you to check that you're getting the tax consequences right, or the other way around. If you don't know what the tax consequences are, it's there for you to calculate it on a rules base. In other words, you either use the rule or you use the consequences approach, but both of them should give you the same answer. One of them is the logical approach, which is the consequences, but the rule is there because it actually needs to help you get there if you don't know what you're doing, shall we call it. So use whichever method gets you to the right answer, and I'll show you how. I've got about 11 examples there, but we're going to fly through them. So I'm just going to jump in. I'm going to jump over this slide just for now because I feel like we're going to come back to that probably later on or tomorrow. Or next month. So what are the first 2 rules? The tax base rules. These are for tax bases of an asset. And this is how they go. There are 2 rules to work out the tax base of an asset, depending on whether the asset, being the carrying amount on the balance sheet, the accounting carrying amount, will generate future taxable benefits, or whether it will not generate future taxable benefits. Depending on which one you're under, the tax base is calculated using one of these 2 rules. So let's do the first one first. Tax base of an asset that will give rise to future taxable profits in your future taxable years, your future tax consequences. The tax base is literally the amount that will be deducted in future against any taxable economic benefits. Now, I'm getting a bit of a message here that I've got a connection issue. Aletta, can you still hear me properly? Yes? Aletta? Okay, good. Keep going. So the economic benefits will be taxable in the future. The tax base equals the amount that will be deducted in future against the tax benefits when the asset is recovered. In other words, when that asset's future economic benefits give rise to future taxable consequences, the tax base is the amount that will be deducted against that. Now we're going to have some examples. I'll come back to it. Just quickly, the other rule. The other rule is if the tax base of the asset, when that asset does not give rise to future taxable benefits, is just equal to its carrying amount. You can see very quickly the second rule is designed to have no deferred tax, because what they're trying to do is if the asset doesn't have any taxable consequences, in other words, there's no taxable income and there's no deduction against it, there's no tax consequences, so the tax base and the carrying amount must be equal each other. That's an easy one. So let's have a couple of quick examples. Now, there are a couple of gremlins in the slides, I think, so we might jump over some of these, but let's see the first example. This was the one I actually used before where I said the cost base of a machine is 100, and for accounting purposes, it will be depreciated over the use of the assets, both for accounting and for tax, but they're going to get depreciated or amortized for tax at two different rates. For accounting purposes, we've already had depreciation of 40 in the current year, let's say, and depreciation for tax has, let's say, in the current year is 30. Now, the revenue that is generated by the machine is taxable. I'll give you a good example of that. The machine is used to generate products, and the products will be sold and generate taxable income, taxable revenue. So that's the revenue that the machine will generate. It will help you produce the products that will drive your taxable income. So the question here is, what is the tax base of the machine? Think about it before we jump slides. The tax base of the machine is, as Aletta, on the screen, is going to generate taxable economic benefits in the future. So we're on the left side of the diagram. What does the rule say? The tax base is the amount that will be deductible in future against any tax consequences when the asset is recovered. Put another way, what's the future tax deductions in the future? And in this case, the future tax deduction is the 100 cost less the tax depreciation that's already been given, which is 30. That gives you a 70 future tax deduction. Now, if you think about this example, that's the way to work out the tax base for the calculation. But I'm going to do the tax consequences approach, which is the way I do it. So when we're having a look at this example, we've got a cost of machine of 100, which we've done accounting depreciation of 40. So the idea behind this is you've actually got an accounting carrying amount of 60, and now you've got a tax base of 70. What does that mean? It means that when the 60, being the carrying amount of the asset, gives rise to future taxable income of 60, you're going to have a 70 of tax deductions against it, being a difference of 10. And that difference of 10 is a deferred tax asset. Why? Because you've got 10 more dollars worth of tax depreciation than future taxable income from the asset when it's recovered, and that difference is a deferred tax asset. That's the tax consequences approach. If you don't know how to do that, it's very simple. What's the future tax deductions of this asset? That's the tax base using the rule. You're going to get to a tax base of 70 against a carrying amount of 60. Aletta, does that seem logical? You think that's easy enough to understand? Let's do another example to move that along. The next example is interest receivable. So same thing here, similar to the previous one. We're going to do the accounting first. We've got interest receivable, which has a carrying amount of 100. Now what that means is an asset of 100 and revenue of 100 in accounting profit in the current year. So sitting on the balance sheet is an asset of 100. Because deferred tax is all about future taxable consequences on the realization of the asset, the question is, when the asset is recovered, in other words, when the interest receivable is recovered, what are the tax consequences that are going to flow? Now, in this case, the interest received will be taxed on a cash basis. In other words, we'll only pay tax on this asset when we get the cash in the future. So you can already see where the answer is heading. We've got an interest receivable asset of 100. That's going to give rise to cash in the future. There's our deferred part, a future transaction of 100. And when that happens, we're going to pay tax, right? Everybody happy with that?
Yeah.
So what's sorry?
Kevin, I think to me what's important and why I've got the journal there it is important to see that if you've got an interest receivable, it means you've already included in your profit and loss the revenue. So, the revenue is
In the
already in
accounting profit
accounting
and loss.
profit.
That's
Yeah,
right.
in
Yeah.
the accounting profit and loss. But we've said, according to the rule that we've made up here, it's not necessarily a correct tax rule. We said we are assuming that we're only going to include it in tax profit and loss sometime in future. So
In the
we can
future,
see
that's
there's a
correct.
difference. There's a difference.
And so when we apply that to the rule, I think it's on the slide. The first question is, where's our future taxable benefit? Is it taxable or non-taxable? In this case, the receivable will be taxable in the future because it's taxed on a cash basis. So we're on the left-hand side of the diagram again, following the rule. What's the tax base? The amount that will be deducted against that. Well, there's no future deduction coming from this. This is a economic benefit that will be taxable in the future with no deduction against it. So the tax base is zero. And you can see already the answer, because if the asset on the balance sheet is 100 and there's no deduction against that in the future, you've got $100 that's going to be taxed in the future in your taxable profit, which gives you your deferred tax liability. 100 asset minus a tax base of zero. But you can get that either way. Either you can use the rule on the screen, or you could just think about it logically. This asset next year or in the future, we're going to pay tax on it. The tax consequences is a deferred tax liability. Therefore, there must be a zero tax base there, because the asset will give rise to a tax liability in the future, or a tax consequence in the future. Also relatively simple. I'll speed along at a little. I think, Aletta, that might be the same example we've just done on the interest receivable. So we'll jump over
Um,
that one.
I think it's maybe slightly
Oh,
different
slightly different. Sorry. Okay. Example two. Sorry, Aletta.
because,
I missed that. Yep.
yeah, I think the heading potentially is
The,
wrong,
the, the, the heading
Kevin.
has thrown me. Absolutely. Yes. This one has, you're right, Aletta, apologies. The trade receivable has a carrying amount of 100. So the same starting asset, the carrying amount is the same. But in this case, the related revenue has already been included in taxable profit or tax loss. You're right, Aletta, that is slightly different. Forgive me. What that basically means is this instrument has already been taxed in the current year. It would have been included on an accrual basis into our taxable profit. So thinking about it before we get to what's the tax base, you can see already that when this asset is received in cash in the future, the tax consequences are going to be nothing. There's nothing to happen in taxable income because we've already paid tax on it in the current year. So the tax consequence approach will give you a zero tax deferred tax. If you want to use the rule, the tax base, let's go look at the two rules. Well, now we're on the right-hand side of the diagram, which is the economic benefits will not be taxable in the future, applying the rule, the second rule. And this one says the tax base equals the carrying amount, because that's trying to drive the outcome that the tax consequences in future is zero, because the tax consequences have all been accounted for or incurred in the current year, in the current year's taxable profit. So I think that's a relatively simple one. And you're right, it was the heading that got me there, Aletta, because that was example 3.
Yeah, correct. And Kevin, the interesting thing is what I'm finding people often get mixed up is when you talk about tax consequences and you are saying, I know there's going to be no deferred tax because we've already included it in accounting P&L, it's already included in tax P&L, there should be no deferred tax. Then they say to me, but Aletta, you've got a tax base of 100. I said, absolutely, because the carrying amount is 100, the tax base is 100, and therefore there's no difference. So you have to be very careful whether you use these diagrams, which are straight from the standard, which force you a
Mm-hmm.
different way, or and also then how you interact that with the tax consequences logical approach. Yeah,
And that's a good point, Aletta, because I think the tax base is an accounting construct, and that was the point that Aletta was making at the beginning, that we're not really trying to get timing differences here. And I really must stress those, because those of you who
yeah,
remember timing differences, which, like I said, Aletta and I are probably in that bucket, it was a different approach, because that approach assumed that there was a timing difference between the accounting profit calculation and the tax profit calculation. In other words, it was transaction based. This one is conceptually balance sheet approach, which means the tax base is being calculated as a reciprocal to work out the consequences on the asset realization. When that asset is realized, what is the tax flow consequences on it? So the tax base is very much an accounting construct, but it is made up of the tax transactional consequences that the tax specialists work with. And that's why there's an interaction there, because the tax guys, no offense to any of the tax specialists who might be on this, but they don't always know what the tax base is for accounting, because it's constructed from tax consequences in the form of an accounting concept in order to apply that against the accounting carrying amount to work out a future realizable tax benefit that flows from the asset and liability realization. Now, in the interest of time, I'm going to move forward because it's coming up on 5 to 12, and there are a couple of examples I want to head through. So, example 4, this is a tax of a loan receivable. Very quickly, the loan receivable has a current amount of 100. We've received the cash already in the current year, let's say. The repayment of the loan will have no tax consequences. And I mean, that's a giveaway in what's happening here. What we're actually saying is there's not going to be any calculation that's going to flow into tax profit or actually an accounting profit into the future. This is really just a cash receipt. We're obviously going to be on the right side of the diagram, because when that asset is realized, it will not be taxable. Tax base is 100 against a carrying amount of 100. There's no future tax consequences, and so that drives you there. So a very quick one to cover us on that. Right, tax base of a liability. It is a little bit trickier on liabilities, I think, sometimes, but let's have a look at what they're trying to do here. The tax base of a liability means you've got an accounting liability in your calculation, which means you've either got a revenue received in advance type liability, or you've got an actual obligation type liability. We've got to pay somebody, settle a liability like a loan or so forth. And I'm just going to run through the two rules, because just like the assets, there's really only two here. The nature of the liability drives the rule in this case. The tax base of a liability, when it's a revenue received in advance type liability, is literally the carrying amount less the revenue that will not be taxed in future period. And what are they trying to do there? What they're trying to do is they're trying to drive a tax base that essentially gives you an outcome on deferred tax that says, well, look, if you've got a liability and it's revenue in advance, what are the tax consequences when that revenue in advance is no longer revenue in advance, but it's actually accounting revenue? What's going to happen? And we'll see that in a couple of examples, which we're going to come up to now. The other liability, let's just have a look at that. So this is all other liabilities. The tax base is the carrying amount less any amount that will be deducted for tax in respect of that liability in future periods. And we've highlighted certain words there, because remember what we're doing here is we're doing future tax consequences. So there's the word future, but also the tax base of these two being liabilities is actually the carrying amount minus something. So just be careful of that. So we're not doubling up. The tax base in this case isn't, when we say tax base equals carrying amount, we're not saying what is the accounting carrying amount minus the tax base. The tax base is the carrying amount minus an amount, and then that is applied against the accounting balance sheet. So it might look like a doubling up here, but actually the tax base calc is starting with the carrying amount. We're then deducting something. That gives us the tax base answer, and then that is applied against the carrying amount of the liability in the actual calculation. Just be aware of that. Let's do a couple of examples to show what we're meaning. So current liabilities in this case includes an accrued expense for the carrying amount of 100. So what have we done here? We've gone debit expense, credit accrued expense, or credit accrued liability. So we've incurred the expense, we haven't paid the expense yet in the current year. So we're going to say here that the related expense will be deducted in future years on a cash basis, which means it's going to be in the future. When we pay this, we're going to actually get the deduction, and the expense will only be deducted, as it says, when it's paid in the future. So let's have a look what rule we're under. This is clearly not going to be under the revenue received in advance rule. And by the way, on the revenue received in advance, it's all revenue received in advance type liabilities. They're not all called that. There's some revenue like contract liabilities and all those. You need to think about whether they are revenue received in advance type liabilities, because that's a category rule we're talking about. But in this case, we're on the right-hand side of the diagram. What we're talking about here is just all other liabilities. So this is a pure obligation where you go pay somebody some money in the future. So what's going to happen here is we start with the tax base is equal to the carrying amount, which is 100, less the amount that will be deducted in the future for tax purposes. So 100 minus 100 gives us 0. That 0 is applied against the deferred against the accrued liability in the balance sheet. So the carrying amount is 100 minus a tax base of 0 gives us a difference, a temporary difference of 100. That 100 in this case is a deferred tax asset. And the reason for that is, if you think about it on a tax consequences basis, what are we actually trying to achieve here? Well, this liability is going to give us a tax consequence in the future of a deduction of 100 in our taxable income. So that is an asset to us. And that's how we get to a tax base of 0, because if we don't have a 0 in the tax base calc, we don't have anything against the liability to compare it to. And that gives us the difference in the deductible temporary difference column. Let that sink for a while. There's a lot going on there. The liabilities are often the harder one because there seems to be double negatives going on here. Carrying amount minus future deductions gives us 0, but it's constructing a tax base of 0 so that when we apply that against the deferred against the accrued liability of 100, there's a difference of 100. 100 minus 0, and that is a deferred tax asset, which is a net deduction in the future. All right, shall we try another one? Tax base of interest received in advance. So the current liability in this scenario is actually interest received in advance for the carrying amount of 100. So you can see already we've changed the example slightly, and we actually have a revenue received in advance type liability on the balance sheet. What's going to happen on this one is the related interest revenue is taxed on a cash basis, which means that when we got the cash, which was obviously in the current year, it's going to go straight into our taxable income in the current year. So the future tax consequences are going to be different. We won't pay tax on it in the future. We've paid tax on it in the current year calculation. That's what's going on here. So what's the tax base of the interest received in advance? Well, let's use the rules. We're on the left-hand side rule. It's a revenue received in advance. Applying the principle, the carrying amount, less revenue that will not be taxed in the future. So what is this giving us? This is giving us a deferred tax base of 100 being the carrying amount, minus revenue that will not be taxed in the future, giving us a 0. So what is this actually going to do when we do our deferred tax calc? Because we're going to compare the tax base of 0 against the revenue received in advance liability of 100. So we're going to get 100 minus the tax base of 0. What is that? A deferred tax asset. Now we're going to say to ourselves, well, what's going on here? Well, what's actually happening is the revenue received in advance type obligation is actually going to hit accounting profit next year, but we've already paid tax on it. So in our tax calculation, you're going to have a bit of a deduction. In the tax calc, they'll actually deduct off that this income in advance that you paid tax on last year. So there's actually a benefit in the tax profit because the accounting profit in future will be 100, but the taxable profit will be 0. So there's actually a benefit there because you're not going to pay tax on it in the future, and that's where the deferred tax asset comes from. That's tax consequences. Okay, now that'll take us up to the next example, which is example 7. And I just help me out, Aletta. Is this one different to the previous one we've done, or?
No, it's similar to example 5, actually, Kevin.
So I think we might have said we've probably done this one already. And
yeah.
So we'll jump over that one. That's the gremlin I was referring to before. I kind of noticed that just as I was getting ready to talk.
Yeah.
Okay, so let's do example 8. This is the tax base of an accrued fine, and now you can see we're actually kind of running in the home stretch now. So the current liability in this scenario, it has an accrued fine and penalty, the carrying amount of 100, and we love fines and penalties. So fines and penalties are not deductible for tax purposes. So what is the tax base of the accrued fine and penalty? So this is a scenario where we have a liability on the balance sheet and we're going to get no deductions in future on this, and we get any deductions in the current year either. So if we apply the rules based on this one and jump on to the next slide on that one, Aletta, we're under the other liabilities. This is not revenue received in advance. It's a fine and a penalty. Applying the rule straight out, the tax base is the carrying amount, which is 100, less any amounts that will be deductible in future periods, and that's 0. There's actually nothing deductible in the current period either, but this rule applies to the future. It's deferred tax. So we're getting a tax base of 100. Why are they trying to get a tax base of 100 there? Because if you take that 100 tax base and deduct it off the carrying amount of 100, you're going to get 0 deferred tax, because there are no future tax consequences of this, and that's why it's driving a tax outcome of 0 in future years, because nothing is going to happen to this. Not only is the expense already in the current year accounting profit, but nothing is going to happen in tax profit in future either. So it's a net 0 future tax consequences. So the tax base here is 100 against 100 carrying amount, which gives you a 0 deferred tax. And like I said, tax consequence wise, you can see that, because the tax consequences in the current year accounting profit are already there. You already incurred the expense, and nothing's going to happen in future. So off you go.
Kevin, I just had
Yes.
another look. Example 7, although the title of the example is similar, the tax consequences are different for this one.
Right.
Because although you've got an expense and an accrued expense liability, in example 5, we actually said that for tax purposes, the expenses will be deducted on a cash basis, and therefore the tax base ended up being null. Here we're saying the expenses has already been deducted
Right.
for tax purposes. So the tax is different. So the accounting in example 5 and 7 are the same, but because the tax is different, the tax base is different and the answer is different. That's what we try to
Good.
illustrate there.
Good spot, Aletta.
So we don't have to go through it. I just wanted to
No.
clarify for those people watching. Let's go on to the next one.
Now, Aletta, I'm actually, in the interest of time, I'm going to say, look, this is a loan payable. It's going to follow the
Yeah,
same rules, and I'm going to leave that as a self-study example. I'm
yeah.
just going to jump straight into the research and development. It's adding a little bit more complexity, but it's just showing the rules in
Yeah.
in play again. Now, these last two examples, 10 and 11, I want to almost say this is a bit of homework before next month. And what we mean by that is, go and have a look at these and apply, shall we call it, the tax consequences thinking, which is really just a logical thought process, but go and see how the rules apply. I'll run through it with you, but you're going to probably need to go just work through them again. The reason why there's a bit of complexity here is we've got a capitalized development cost of 500,000. So we've created a capitalized intangible asset on the balance sheet of 500,000. But we've also incurred some expenses during the current year of 300. In other words, those have not been capitalized to the 500. And we've claimed a tax deduction for both over 3 years of 33.33%. So what's actually happening is there's a bit of a balance sheet approach happening in the tax deductions for both items, but actually
Mm.
for the research expenses, they've all been expensed for accounting profit in the current year, but the capitalized development costs incurred in the current year, they've gone to the intangible asset. So let's just think about that. What's actually happening is 1/3 of the 500 has been incurred from a tax deduction point of view in the current year, and 1/3 of the 300 has been incurred as well. I hope I got that right in terms of the fact pattern, Aletta.
Yeah.
But only 500 have been capitalized from the tax base of the asset. So let's just apply the rules. It's obviously the economic benefits from this will be taxable in the future. And it's very similar to the PP&E example. When we use this intangible asset and generate future taxable income, future income, like from revenue sales, it will be taxable. So this asset is a tax generating asset in the sense that it creates future revenue, which will be taxable. So we're on the left-hand side of the diagram, and the tax base is how much will be deducted against that in a tax calculation. That's our tax base, is the future deductible amounts. And what we've actually got here is we've got 2/3 of the 500 that'll be a future tax deduction, and 2/3 of the 300,000 that's going to be a future. I hope I've got that actually right in my calculations. I haven't actually
I
checked that.
think I think, Kevin, we're just looking at the capitalized development cost in this example. So we're not
That's
looking
right.
at the research. Yeah.
All right, so you've treated these as a separate item on
Yeah,
this one, and
yeah,
Aletta's right. Actually, have a look at that. It's two-thirds of it will be deducted in future. So we've got the 500 minus the current year's tax deduction, which will give us two-thirds in the future, and
yeah.
that is our tax base against the 500 that's sitting on the balance sheet, which will actually give us our deferred tax liability. So go and have a look at that one. Now, later, I will be honest, I have not looked at this one, and so maybe we can struggle through this one together a little bit.
Yeah,
Um,
I'm happy to. Kevin, I just want to make a final comment on this example 10 and going back to the fact pattern. If we've
the,
got research expenses that's been incurred, um, research expenses we know, for accounting purposes have to be expensed, and development cost, if you meet certain criteria, could be capitalized. We've got here that tax deduction for the 3 years, it relates to both of those. And that's
Mhm,
actually a really critical aspect, because it means from a tax balance sheet, we've got a research amount that can still be deducted in
that's right.
future. But in the accounting balance sheet, we don't have it. So it's interesting. We always say when we do deferred tax calculations, start with your accounting balance sheet, all the assets and liabilities. And then we say, now think, are there any things that are potentially sitting in a tax balance sheet that is no longer in your accounting balance sheet?
That's right.
And these research expenses is a very good example of that. And I think that is something that we
And
should
that's what I
add
was
to the
probably
discussion.
trying. I was trying to kind of do that in one full swoop, but I realized your
Yes,
solution didn't do it that way,
yeah,
because I was already adding the deferred tax, shall we call it,
yes,
benefit from the expense into my calc. But you are
yeah,
correct, Aletta, that if you're starting out on this on a basic level, you should do them separately. Do them
yes,
separately because you need to keep track of, shall we call them, the separate line items and their cumulative impact. I was trying to wrap them up together, but there is a leg that's actually missing there. And I think maybe
yeah.
what I'll do is we'll incorporate that just to show you in the next month, just to make sure that you can cover it off, because there is actually another, shall we call it,
The
a
research.
tax liability, or net tax asset, deferred tax asset sitting there on the research expense, which has all been fully expensed in the current year.
So, Kevin, on example 11, we have a similar principle actually. And that is, when you do these deferred tax calcs, I always prefer to keep them separate. So, I would do research separate and development separate in the previous example. And in this example, I would do gross trade debtors and the provision for the doubtful debts separate. Now, I know some people could combine it and get to the right answer. But for my purposes, I say in my example, let's keep it separate. To me, that is, the foolproof way that I don't get myself confused. So in my fact pattern, I had the gross amount of trade debtors is 1 million, and the doubtful debts that we've provided for was 300,000. So we're sitting with that provision for doubtful debts, 300,000. It will give you in the balance sheet net debtors of 700,000. And then we also say that we'll claim a deduction for those provisions for doubtful debts when the debts are actually written off in future. So this is just not, this is a provision. Yes, it's already an expense in accounting profit and loss, but it's not expense yet in the tax calculation. So let's look at them separately. So if you look at the tax base of your trade debtors, I've said the economic benefits of that gross carrying amount of 1 million that I've got there will not be taxed in future, because once you make the sale, you say debit trade debtors credit sales, it will be included in accounting profit and it will be included in tax profit. So it won't be taxable again in future when your debtors pay you. Therefore, the tax base is the same as the carrying amount. The tax base is also 1 million. So there's no deferred tax implications on the gross amount of trade debtors. And this is similar to an example that we've done earlier where we just looked at receivables. However, if we then go on, and why do I have development cost here? Did I go the wrong way? If we then go on and we look at the tax base of doubtful debt, so just the provision, and I've put in brackets there, remember this tax base, this doubtful debt, technically we call it a negative asset. But when you look at the rules to use, you use the rule for liabilities because it's a credit balance. You will use the rule for other liabilities, and you will say the tax base is the carrying amount less any amounts that will be deductible for future tax purposes in respect of that liability in future. So remember we said in future, if this provision for doubtful debts turn into a real bad debt, then you'll get the tax deduction. And therefore, the carrying amount of the provision is 300 less that deduction that you will get sometime in future, so the tax base is 0. So it's this provision for doubtful debts that has a deferred tax implication, not the gross debtors. So that's how, how I keep the two separate. The other thing to maybe conclude the session, how do we know whether we've got a DTA or a DTL? Simple rules. If the carrying amount of an asset or the future economic benefits of an asset exceeds the tax base, what you can deduct in future, then it means you're going to pay tax in future. And obviously the opposite also holds true. So you can think about it logically as Kevin explained it throughout, or this is just rules to maybe capture it and make it simple. And then finally, I think what's really important, there's a standard format on how to do a deferred tax calculation. So you have your assets from the trial balance, your liabilities from the trial balance, and I've put in red, consider tax balance sheet. That research expense is in the tax balance sheet, not in the accounting balance sheet. The carrying amount column is easy. It's from your accounting trial balance. The tax base column is the problem. And that's what we've been talking about today. How do we come up with the 4 rules with the tax bases? Then the difference between your carrying amount and your tax base can either give you a taxable temporary difference, and it will be a DTL therefore. It could be a deductible temporary difference, which will result in a DTA. And I've also put in a third column, a temporary difference that will go straight to equity. Now, it will still go to a DTL and a DTA, don't get me wrong, but the other part of the journal for those items will not go to profit and loss, will not go to an income tax expense. So already in my calculation, I prefer to keep items that relate to equity completely separate, because I know I'll have to do my journals completely separate. And then at the bottom, I've made a note that when you work out your deferred tax asset and deferred tax liability at reporting date, you also have to compare it to your balance at the end of the previous year. And then you have to say, if I had a DTA last year and I've worked out a new DTA, what is the movement? Your journal is just the movement. The same with a DTL. If I had a DTL last year, I have a DTL now. What is the movement? My journal is only the movement. So a few comments that we've made in red there to try and bring home the message. So if you have to come up with a tax base, these words from this diagram is from the standard. Tax base of an asset, paragraph 7. And I've just put the words from the standard in a little table on a tax base for an asset. And then AASB 112 paragraph 8 talks about the tax base of a liability. And then you've got your rules. So thank you very much for joining our webinar today. I wanted to get a really important message out around sustainability reporting, but also do the real basics on income tax. And we'll look at some complex matters next month. Thank you for joining us. If you need assistance around general purpose financial statements and that transition, please contact us. Our accounting news is going out today or tomorrow. Look out for that. Some great articles in there. And please reach out to any of our partners or leaders or anyone in our team if you've got questions on how we can help you with IFRS or sustainability reporting. Thank you very much. Thank you, Kevin. Goodbye.